So we was like money talks.
Yeah, we figured we would just record this conversation because this shit is. I'm not having this conversation again. Like,
Why? Okay, so that was funny that you said that. So why? Because you're understanding everything you need to know.
No, because the way that this conversation is unfolding right now is going to be unlike any way that it unfolds in the future. So I'm like, we got to do this conversation right now. Like, I'm trying to figure out if I can get a life insurance policy where the money that I put into the policy purchases into an index or purchases into a mutual fund that buys shares on the stock market, and then with capital gains, maybe they do options in there.
I think
maybe they do different, financial instruments in there, but they're doing strategies and they're making capital gains while the money is cooking in the life insurance policy, so that when I'm ready to cash out, or if I die, or if I want to take out a loan against it, I get the value of what all the money I put in is worth, as according to the index of the S&P 500, as if I was buying the index with that money. And I want that to be the value of my life insurance policy.
That's what it's going to be minus the cost of insurance. So when we were talking earlier, it's not free to be in the life insurance. So if you bought basic life insurance, like term life insurance, which is the cheap stuff you see on TV at 1 a.m.
Right.
That's going to cover a death benefit on your body for 10 years, 20 years, 30 years, or whatever that term is. You would just pay that premium and then it goes away. So most people, 97% for life insurance for dummies, if you read that, I've ever read that or want to read it, 97% of term life insurance claims are never paid. So
wait, what the hell? Why are they not paid?
Because people outlive 10, 20, 30 years. They buy.
Wait, so you telling me they got life insurance policies that are anything less than the day you die?
Right, which are those.
So what you trying to say, like, oh, well, if I die in the next 10 years, pay me this money?
And most people don't.
That's crazy. Why would you buy that, though? Like, for what reason?
Because for the cost, because they don't realize they can get a permanent
I see. I guess
death benefit.
If you're like 80 years old and you think you only got 20 years left max, why?
They don't even sell a 20-year term. You might not even be able to buy it. Most carriers don't sell shit past age 70 something.
So you can only buy those kinds of policies when you're young? Even though, like, you probably gonna live past 10 years, like, what, you're just gonna buy one?
This is where the conversation comes in with the putting cash value life insurance in your portfolio.
Right.
Because you have an account that's not only operating tax-free while you're living, but whatever's left in the account goes to your loved one tax-free.
Yo, hold on, I have a question about that. Yo, Joshua, we're recording content right now. Feel free to get into this conversation if you want to. Like, we're talking about an IUL life insurance policy.
He's like,
he's like in the middle of a chocolate conversation.
Joshua's a genius in his own right. Like, he'll definitely have something to say about this.
Okay, cool.
You know what I'm saying? So y'all, this is Joshua, human design genius.
Thank you.
And otherwise
glad
genius.
to be here. Yeah. Thanks for having me on the show.
So you're trying to figure out if I can get a life insurance policy where the money that I put into the policy every month is literally buying into the S&P 500, so that if I die or if I'm taking out a loan against it, I get to leverage against the value of all that money as if it bought into the S&P instead of just sitting in cash. And he's saying that's true, but my question is, if that's true, is all they're doing buying the S&P, like the ones that have indexes, like you were saying, Fidelity and stuff like that? Like, are they just buying the S&P, or are they using other strategies like doing options, like option calls, puts, and stuff like that? Okay.
So it's going to take us a little longer to go through them.
For sure.
It'll have an explanation of each one.
And those are the ones I'm going to want, because I can do those things myself. So the thing is, if I can already do it myself, if what I'm putting my money in isn't doing at least that, I don't want it.
But you're not getting the whole deal.
And I know I can get that too.
But you can't change the tax code.
But hold on.
And life insurance.
But if anyone could, it would be Marvin.
Yeah, I would try. No, probably not. The IRS, nah.
So no capital gains, no matter how much you grew over any amount of time.
Wow, that's
and
good.
No income tax at any time. And there's no minimum retirement age or any age to touch the money.
Hold on. I believe you, but I gotta say this clearly so that it's articulated as if said from me, because now I'm gonna be able to speak on this. And now that I'm realizing this, are you saying that I can put money into a life insurance policy where where the value of that policy is essentially created from a firm that invests into the stock market with that money, and a few of the strategies that they do or might do is obviously buy shares on the market or buy into the index, and also do option strategies, like which is short-term gain and short-term losses as well. So you're trying to tell me that those capital gains from those short-term capital gain financial instruments in the option play, like when they do option plays and they make a profit, like nobody has to pay taxes on that profit?
The consumer is not going to pay any taxes on that.
But will the tax money be taken out and given to the IRS?
From your policy?
Yeah.
No.
Oh, see? Now
No.
that's a game changer right
No.
there.
There's
That's
no
crazy.
reporting to the IRS. Now, if you get the wrong policy, or you try to put more in your policy than that limit that you have,
Right.
that becomes a taxable event.
Now,
But
now,
most of those companies don't let you do that, which is called a modified endowment contract.
So there's no policy that operates like this with an unlimited amount of money. Right?
No,
You
there's
can't
no
put as-
unlimited cap.
Okay, you
but-
can't put as much as you want in.
No, but here's the deal. So there's going to be.
So this is a government-backed policy, then, right? Like there is a government regulation that's specified for this kind of policy. Like
Yes.
they control those limits.
The laws
And
of that.
because they don't want somebody to just be able to just get one and just put like $10 million
They
in there.
used to.
Oh,
People used to.
but they
Yeah.
don't anymore.
When there's economic downturns, people will put $1 million in, and then the death benefit $100,000. That
Damn.
doesn't. It's topsy turvy.
Right.
So they brought this together in 7702 B or A or B in the law in the tax
Oh,
code
okay.
that they updated for that limit. So they changed some of that.
So are you allowed to put Are you allowed to put in more than 100% of the death benefit?
Good question. So no, but eventually it will. There's a calculation on that. So eventually it will go over that, but you can't just flood it like that at first. Like you can't put $1 million of cash in the death benefit, 500,000. Like no, but like you have a 500,000 death benefit policy, it's going to get to $1 million.
Right.
But it takes. There's a
I see.
calculation of time that has to take.
So the value of the death benefit is leveraged against the value of the gains on the S&P or whatever fund they're investing in, like whether it be they're doing the S&P or they're doing QQQ, S&P, Bitcoin, and some option strategies like in your portfolio. All that stuff would be like the value of that fund would be like your new death benefit limit. So then, like, if you put in $10,000 and you made 100% in the S&P, now your cash value is $20,000. Now your death benefit is also $20,000. Now you can put $20,000 next time.
Pretty much. So good. You're there.
I want to know how to roll this up.
You're there. So
Yeah.
like my death benefit on one of my policies is $100,000.
Okay.
The cash value account is at 9 or 10,000. So I have 110,000 death benefit.
Oh, so it's combined. So it's the death benefit plus the cash.
And then anything I've taken out, if I then pass away and I haven't put the money back in it, that's subtracted. My family gets the rest tax free. So I have out 9,000 right now. The death benefit's 100,000. If I die on the way home tonight, I hope never. How much does my family get?
I guess 109,000.
Let's do the test again.
Did you say 100,000?
So if I take out 9,000,
Oh, you take out 9,000.
and I haven't put it back, and then I die,
Yep.
how much my family get?
I mean, they getting 91,000.
Damn.
You know what
So
I'm saying?
it's a credit card on your life that you never have to pay back. Why would you pay it back? Because you're going to put more money back into your account to give you the compound interest that you deserve.
Right. Yep. And then, so when you take out loans against it, do you take out loans against the death benefit plus the cash that you put in, or is it just one or the other?
Good question. So it's gonna be considered the same bucket. So if it's 100,000 death benefit, you have 10,000 in cash value, 110,000.
Okay.
The loans are against the 110.
Oh, so you can take out a loan against the whole thing.
90%.
90%. Okay, 90%.
10% stays in to keep the death benefit active.
Right. Wow.
Because they want your family to have at least 10% of what you got for the final expense.
And when can you take out a loan against it? And is there any like criteria for you to be able to take out a loan? And when you do take out a loan, what's the repayment look like? Do you pay interest on yourself, or like how does that work?
So this is why you have to work with the right agent or broker, and I'm not even like on bullshit. Because when I look at people, I always get new clients because I'm like, well, if you don't mind, like, if you're comfortable with me, you can send me your policy that you have now, just so I can show you how the cash is growing.
Right.
So two things to look at with these kind of policies is obviously how much can it grow for you. So there's going to be what they call a cap rate, which is the max you can get, and a floor, which is the minimum return. Most index universal life is going to be a 0 floor. If you work with the right broker, we can get you a 2% floor. The IUL I have has a 2% floor.
Yeah.
So even if the market's negative, you get 2%.
Okay.
Then a cap rates right now are at 8, 9, 10, 11, 12% a year on different IUL products. Okay.
Yeah,
So then,
say, like, bunions are like hardships that we've dealt with. Like,
what was the second question?
So like, when can you take out the loan?
When can you take out the loan?
Yep.
Okay, so this is a big thing though. So a lot of policies, the loan rate is high, and so that's where the insurance companies getting you back, because he's like, how's all this happening? There has to be a catch. Most of them there are, but there are a few that really are for the consumer. So you'll see policies with loan rates at 5, 6, 7, 8%. Well, those policies probably aren't growing at 5, 6, 7, 8% every year.
Right.
So that's where the insurance company makes their money, when people take the money out. Now, when you have the right agent or broker, you're going to be able to get policies that the loan rate in the first few years is 2 or 3%, 2.3 or 2.5, 2.75%.
Yeah.
In the same policy, though, your policy is going to grow at a minimum of 0 or 2%. So if you take your money and you're using it over here, you might pay 0.75%.
Interest?
You're not paying it to anyone. It's paying into your policy, though. Like,
Right. But there's no interest.
Now hold on.
Because you do have to pay it back. Like, money has to come out of your account and back into it.
If you want it to grow better, yeah. But
Right, what I'm saying, like, once you take out the loan against it, right? Like, don't you have to pay it back?
no,
You don't have to pay it.
because what's the leverage?
Oh, because it just comes out of your.
What's
your,
the leverage? Your life.
Exactly. It's just
Not
your
a
life.
vehicle, not a car or a house
Right,
or whatever.
right.
There's
So
no one's gonna repossess your life but
Wow.
God.
You taking a loan out on your life, son? Yes.
So
No, that's good.
One of
That's
my
good.
policies, I have the loan rate after year 5 is 1.5%. First of all, where are you getting a 1.5% loan?
And what if you don't pay it back? Like, what? They take your life?
right, like our.
So it comes out of the death benefit.
They hunt your ass
It comes out
down.
of the death benefit, and your family gets the rest.
Oh, so your family just gets less when you die.
I
got you. I got you.
If you put it back in, you're just gonna regrow your
Okay.
account to use more while
Now,
you're living.
okay. Now I see what you mean when you say this is a credit card on your life, because you just draw from it.
When you need,
And,
you
like,
put it back when you need.
Yeah, you can just put it back when you need it, and that amount is that amount.
And
Like,
there's no taxes.
and when the deal is done, that's the amount that's going to be left. Like, if you take money
tax
out,
free.
exactly, tax
No
free.
capital gains.
Right? Yeah. That I know. There's no taxes on loans. That I know for sure. I just didn't know if taxes were being taken out of the capital gains that are being made when the fund does, like, for example, an option call, and let's say they make like a 50% return on a play in 1 week, right? There is a short-term capital gain tax that must be paid because they held and sold an asset in a time period that was less than 1 year.
Heard.
So because of that, and it's a high rate, it's like 30%, like it's high. So I'm like,
Most of the
does that come out?
Most of the strategies credit once a year, annually, and it's not calendar year. It's on the insurance contract's anniversary date.
Yeah.
So if it's 11/1, 11/1,
But like they can credit whenever they want. But in their fund, they're running plays, right? Like they're buying
on
and
the
selling.
back end.
Yeah, right.
But on your account, it's either going to be some of the strategies are monthly. They have a month-to-month credit, or they have annual.
So they don't. So whoever is doing the trading, like to build the value of this account, they're not subject to short-term capital gain.
They could be, but the insurance companies just license them your usage, so they don't. They're not subject to it.
The reason why that's important to me is because that's taking money out. You know what I'm saying? That's making the value less than
you're getting
what the perceived value
the cost
would be.
of the insurance is the only thing that.
No. Now I'm running an analysis on their gains. I want to see what happens when they make gains. Where do those gains go? Like do they just put it back? Because they have to grow their fund to be able to invest more and more so that it can compound. So there has to be a pool of money, and then that pool of money has to grow, and then they have to pull from that pool of money and buy and sell shares and do options and things like that.
They're working on the back end because what the insurance product is giving you is no loss protection. There is no downside ever in the account. Every single year you go in the account, there's more money. There can never be a subtraction of money unless you take out money.
Wait, so is the return percentage like a fixed amount, or is it adjusted with the actual rate of the market?
It depends on which index that you choose in the policy. The regular S&P 500, they call it point to point. It's going to be the point of the start of the contract year and then the end of it.
Right. And what's that amount on the S&P?
It just depends on the policy, like 8, 9, 10, 11%, 12%.
Okay. So they're not giving you the whole thing. Because last year the S&P did 28%.
That's great.
Like would I get 28% on my?
And then what did it do over COVID? -20.
Hey, buy more. Hey,
but
buy more. I'll put more money in. Oh, it's getting smaller. It's buying the S&P. I'm getting because I know what it's doing. So I'm gonna do what I would do as if I was investing. Oh, the market's down. S&P is down. Well, that means all of America's down.
What you're gonna do in your account, that's in the market, but in your life insurance, what I was trying to explain was that the insurance company is taking and reinvesting when they keep a portion of your upside. That's because you have no downside.
Right.
They eat that part when the markets are down. So that's why it's a balanced approach when you have an account inside a life insurance.
Yeah. So there's no downside. So like you only benefit from the upside. So they put a floor on your losses. They're like, no, you actually can't lose.
The account only goes up, and that's a guarantee to only increase. And that's what you sign on the illustration. You see the minimum is either 0 or 2%, depending on the company, and it's on a ledger. There is not one account you put your money in, period.
And you know what?
Other than life insurance that says guaranteed return for every single year of your life. As long as you do your part, these companies that represent 150, 200 years, check your bank. Most of them have not been open that long.
Damn.
Most of them don't have billions in assets.
I mean, that's true. You know, they talk a big game because they play big game. Like they have access to so many assets, and the money, it's all printed. Like it's not real. Like it's fake. Like it's printed money. Like they could just print the money. Like at the end of the day, even if I took out a loan against like a $2 million policy, 1 million, and then there was $1 million left, and let's say there was a downturn in the market and America's coming down crashing, like they have so much in assets, they could still guarantee that, like if worst case scenario would happen. So I can see how a fund or like a big company like that would be able to like protect against downside. And at the end of the day, it's on your life. There's nothing more valuable than your life.
Now that's just life insurance. If you got older parents and stuff, they got a lump sum of money from a 401k or a brokerage account or whatever, they can buy income for the rest of their life and never run out of money, ever.
That's fire.
That's guaranteed lifetime income. It's called. It's a private annuity or a private pension. So people who understand pensions, maybe had a government job or whatever, people who don't have access to that. My uncle I have a few different clients, but it just depends who you are. But
just send me the link.
AmericasProtectionSolutions.com.
Hey, AmericasProtectionSolutions.com. Except he's gonna hit me up directly because we're gonna have to continue this conversation because I'm definitely gonna search for one of these policies. Like I need to have a life insurance policy where I could just put in like maybe like $100, like maybe $200 a month, something like that. Like nothing too crazy. It could be $150, not a big deal. Where like that money goes into something that grows with the stock market, specifically the S&P 500, the best 500 companies in America. They will always be the best 500 companies in America.
Benefit attached for the rest of your life.
Exactly.
You don't get that with a brokerage account.
Exactly.
You don't get that with a bank account.
And he loves that, and I love the fact that you can take out loans against it because that's powerful.
I missed something, and there's so much that I get excited over because this shit works.
Oh yeah.
But what about if you're anyone like me who has in their family heart attacks, strokes, cancer, right? That touches everybody. 1 in 3 of us have one of those events happen to ourselves, statistically. So some of these index universal life policies, in that cost of the insurance, you get what's called living benefits. So my cousin had a stroke. She had a $25,000 policy. It had living benefits. The death benefit was $25,000. She had a stroke. She was able to take $7,500 tax-free out of the death benefit. She had the policy for 9 months. She only had $1,000 of cash value. So the living benefit turns this amazing bank account
it's like extreme life insurance with a bank behind it, with something that's growing your money, and tax free, and then the amount you're able to take loans out against it grow when that value grows. Like I think that's incredible. That's incredible. That means that how I would play it. Obviously, something happens to me, something happens, but like let's say I have it, I would just put it as a part of my investment plan. You know what I'm saying? Like I have a whole investment plan with like my portfolios, like my crypto wallet, like my real estate assets, and I'm like, all right, what is my net worth? Like what is the total value that I'm able to leverage against in my life, like while I'm living and after I die, because I want to pass this on to the future generations, even though I don't have kids,
Yeah. And they're not all going to be tax free.
Exactly. They're not all going to be tax free.
No.
Like you got the Roth IRA, that's tax free. So that's good. And then I got the Roth 401k, that's also tax free.
That's a whole nother conversation.
Yep. We're not gonna get into all that. I'm gonna stop recording this in a minute.
I know.
But yeah, so like the more
there's Roth annuities though.
Oh my God, Roth annuities. I heard about the Roth annuities.
Okay, so why do we love a Roth? Because
it's tax free on capital gains.
Bam. And what else? Because you guarantee the principal, and in other retirement accounts, the principal is not guaranteed. Right?
Yeah.
You can lose the principal. So Roth you can't, but you can lose your gains. Okay. So if you take your Roth and you have a baby with a fixed indexed annuity, now you lock in your gains too.
Wait, because you have an annuity.
There's no loss.
Oh, so
next time the market comes up, boom, you never lose.
That's good.
Now the Roth IRA I have in a fixed index annuity has a 9% cap.
Oh, so you can't make more than 9% gain.
But I can't lose.
But you can't lose. You know what? That's really good. That's really good. Part of me questions if I would do that because I'm like, I like to take risks.
And have more than one.
That would be something where I'm just like, you know what? This doesn't need to be a risk. Like this could just be what it is and let it go.
You can have a tax-free rollover from another Roth to this fixed indexed annuity Roth.
Yep.
It's a zero taxable event.
Yeah, but
it's not your contribution for the year, so you can do a rollover.
Right.
Still have your.
But it has the same contribution limit, right?
Correct. Okay. 7,000 or whatever right now, but yeah.
Okay.
Yeah.
That's cool. That's dope. Yo, thank you, bro. I'm definitely getting one. Like, what was it called again? Say that.
America's Affordable Protection Solutions is the company. AmericasProtectionSolutions.com. And reach out, schedule with us. There's no cost to talk to us. Come to one of my yoga events. You'll hear about the mind, money, and spirit at Darian's Lifestyle, Darian'sLifestyle.com. Where they find you at?
Yo, find me at Money Marv Fool or at Titus Tax Pros if you need to get your taxes done. I talk about money, like I talk about investment, I talk about spending, I talk about loans, I talk about retirement, I talk about assets, I talk about what's going on right now with the money and what's going on, how it's flowing. So let's talk about it at Money Marv Fool. I'm probably gonna post this on there.
Hell yeah.
Hell yeah, bro.
Love it. You're welcome. Thank you.
We got this. Yeah.